The government said while it was impossible to estimate the overall impact of Hurricanes Harvey and Irma on third-quarter GDP, preliminary estimates showed that the back-to-back storms had caused losses of $121.0 billion in privately owned fixed assets and $10.4 billion in government-owned fixed assets. Harvey and Irma struck parts of Texas and Florida in late August and early September. Hurricane Maria, which destroyed infrastructure in Puerto Rico and the Virgin Islands, had no impact on third-quarter GDP growth as the islands are not included in the United States national accounts. Economists had forecast the economy growing at a 2.5% pace in the third quarter. This is a positive report for an economy that was battered by two hurricanes late in the quarter, but it is not as strong as the headline 3.0% growth might suggest, said John Riding, chief economist at RDQ Economics in New York. With post-hurricane labor market, retail sales, and industrial production data already showing an acceleration in underlying economic activity, the mixed GDP report will probably have no impact on monetary policy in the near term. The U.S. Central Bank is expected to increase interest rates for a third time this year in December. The dollar rose to a three-month high against a basket of currencies on the data. Prices for U.S. Treasuries fell, with the yield on the interest rate-sensitive two-year note touching a fresh 9-year high. The economic recovery since the 2007 to 2009 recession is now in its 8th year and showing little signs of fatigue. The economy is being powered by a tightening labor market, which has largely maintained a strong performance that started during former President Barack Obama's first term. Though U.S. stocks have risen in anticipation of President Donald Trump's tax reform, the administration has yet to enact any significant new economic policies. Trump wants big tax cuts and fewer regulations to boost annual GDP growth to 3%. Inventory boost. Businesses accumulated inventories at a $35.8 billion pace in the third quarter in anticipation of strong demand. As a result, inventory investment contributed percentage point to third quarter GDP growth, after adding just over 0.1 percentage point to output in the prior period. While export growth slowed, that was eclipsed by the steepest pace of decline in imports in 3 years, leaving a smaller trade deficit, which added 0.4 percentage point to GDP growth. Trade has contributed to output for 3 quarters in a row. Hurricanes Harvey and Irma, which hurt incomes and undercut retail sales in August, crimped consumer spending in the third quarter. Growth in consumer spending, which accounts for more than 2/3 of the U.S. economy, slowed to a 2.4% rate following a robust 3.3% pace in the second quarter. Despite the moderation in consumer spending, inflation perked up in the third quarter, likely as a result of disruptions to the supply chain caused by the storms. The Fed's preferred inflation gauge, the Personal Consumption Expenditures, PCE, price index excluding food and energy, increased at a 1.3% rate. That followed a 0.9% pace of increase in the second quarter. With inflation rising, income at the disposal of households increased at a 0.6% rate, breaking sharply from the second quarter's strong 3.3% pace. Investment in non-residential structures fell at a 5.2% pace in the third quarter, the biggest drop in nearly 2 years, as spending on mining exploration wells and shafts grew at only a 21.7% rate, a sharp decelerating from the second quarter's 116.3% pace. Spending on non-residential structures rose at a 7.0% rate in the second quarter. Investment in home building, which was already undermined by land and labor shortages, also took a hit from Harvey and Irma. Spending on residential construction declined at a 6.0% rate, contracting for a second straight quarter. Business investment on equipment rose at an 8.6% rate, increasing for a fourth straight quarter. Government investment fell for a third straight quarter.